Bonjour and welcome to La French Tech on Air, our European video podcast series on business and technology. In Europe, La French Tech ecosystem is made of 27 communities that are connecting to the French tech startup scene and creating a bridge to European tech movement. My name is Billy Yen. I am a board member of La French Tech Krakow. I will be your host and moderator for today. Our guest of today is Jerzy Krypel, attorney at law at BSJP. Welcome, Jerzy.
Hello, thank you for having me. My name is Jerzy Krypel. I'm an attorney at law at BSJP, a Polish law firm with French, German, and Scandinavian desks. Within our professional practice, we cover most of the fields on the market. Although personally, I focus on commercial and corporate aspects of business activity, including mergers and acquisitions. I mostly focus on French clients, but not exclusively. There's no discriminating right there.
Thank you, Jerzy. Today we'll be talking with Jerzy about the danger connected to raising a financing for a company. So my first question for you, Jerzy, will be, what are the ways of financing a company?
Well, there's multiple ways. We can think of funding our company from public funds, like governmental programs, also community programs like European Union programs. Although this changes very often, and we have to adapt to given conditions on given program and adjust our company to it very often. But beside that, when it comes to to raising financing for a company in private sector, we can start from even this friends and family circle, right? Which is very common for the company to start from.
I think we call it love money, right?
Yes, we call it FNF, and sometimes people have a different abbreviation for this, not only friends and family. Okay. But let's leave it in here. Yeah. But beside the friends and family circle, we have also more structured, obviously, ways of financing the company, like raising debt, which is borrowing money from the bank, raising equity, which is opening the company for outside investors. We can open the company for shareholders, for employees, for venture capitals. We can crowdfund our company also, and we can also proceed to some more advanced sources of financing, like bootstrapping or mezzanine funding. So there's multiple ways. It depends on the given market, on the given conditions, on the situation of the given company also. Mainly, I would say.
Yeah, I can imagine that different profile of company have different needs, and according to your professional practice, which of these options are the best or the most common?
The best. Well, it would be hard to respond to this question unanimously for all the companies, because the type of financing that we choose depends on the company's situation, including financial situation, history of the company, etc. So we can choose the best financing for a given company. When we have the company on the table, we can choose the best source of financing for this given company. But if we gave the final response to this question that this financing is better than another, we would have to scrape off all the other forms from the screen. So I would go for the two most common from my professional practice that you also asked for, which would be raising debt and raising equity, basically borrowing money from the bank on one side and opening the company for outside investors, giving them some part of the business, right? Shares. That's how they become equity investors, equity partners in your business.
Okay, so I guess both of those options are valuable and can have lots of benefit. But today we'll discuss more the danger of this investment. So maybe can you tell us what are the biggest difficulties for a company raising one of these capitals? Is there any pattern you can see?
When it comes to raising debt, it's more structured and it's more on the side of the bank. They impose some kind of rules, right? You have to have given history of the company. You have to have like certain revenue. Sometimes provide the bank with collateral most of the times. So for financing at the bank, you can prepare. You have to very often prepare the company to be eligible for the debt, right? The situation with raising equity is much more complicated. Therefore, it's much more interesting at the end of the day. There is many challenges that investors are, or maybe founders looking for investors are facing. And well, I would go for the fact, like, first one that I saw in practice already is that, like, very often founders of the company are seeking for a business angel, not an investor. And I'm not saying that an investor cannot help the company grow. They can provide with, like, information, mentoring, contacts, money. That's the goal, right? But in order to get the investor in the first place, you have to have a vision. You have to sell this vision. So I would say the biggest problem of the founders is looking for investment, or for investors at the wrong moment, when the company is hitting the wall. They don't know what to do, and they are like envisaging, like, this option of getting outside investors for the company. Meanwhile, you have to convince the investor to
Yeah,
invest
of course.
to your company.
Because at the end, the investors is looking for some return on investment.
Exactly, that's a product for them, right?
Yeah. Mm-hmm.
So I would say that's a vision, but that's only one thing, and that's very general. So I'll try to be more precise with legal aspects, because there's, like, also very tangible elements, like, for example, structure of the company, right? There's some structures that are, like, simply inadapted to opening themselves for investors, like partnerships, for example.
For our audience who might not be aware of that, can you explain a bit the difference between business angels and investors?
Well, from my perspective, from what I was saying, is that, like, when the investor is putting money on the table, wants to get some shares in your company, it is a product for him, right? Business angel as some kind of mentor of the company, who is, like, giving the hand to the company, like providing with information, providing with contacts, saying, like, hey, you have to go a little bit right. You have to, like, switch a little bit your attitude right now, because your product is great, but maybe your client, chosen client, final client is not correct. So, business angels will probably show the way to the business, right? Investor is more like money focused. I'm not saying that, like, as I said, I'm not saying that investor cannot have this double role, and which is very often the case, because once I put the money on the table, I want this company to prosper, so I will also provide it with, like, relevant information, my contacts maybe, so it can be double role also. But we were discussing also this other problems of, like, structure of the company, right? So I said that some of them are inadapted to get investors, but, like, maybe you should think of, like, changing the legal form of your company before you get for an investor. In Polish market, that would be limited liability company, share stock company. We got recently, like, simplified share stock company. So, like, these legal forms are adapted to open themselves for investors, give them shares. They have already, like, custom made solutions for, like, shareholders, for associates of the company. So that is form also of the company. But, like, I would also say this is not very that it's very neglected very often. But, like, company don't have structures within the intellectual property right, or kind of procedures, right? This is also the, like, big problem. If me as an investor, I want to put some money on the table, I want to make sure that the company has all the intellectual property issues solved, right? Very often they're developing some some products. I want to make sure that they have all the rights to this product. I want to make sure that the procedures are intact. I'm investing in some given investor, but once he gets sick, I want to know how the company functions. What are the procedures, right? So it might be a good idea to write it down.
So actually, there is some homework on the side of founders or entrepreneurs or anyone looking for some investment money, because they need to understand that it's a business partner, so they need to provide some security on their side as well.
Exactly, and very often defend their position, defend their point of view, because around the table when investor is um, double checking certain situation. Okay, what are the procedures? Okay, why is it like this and that? You have to know how to defend your company. It's your product. You're going to sell it, right? So as you said, there's a serious homework to for founders to make before seeking for an investment.
And on this side, I mean, I want to go a bit further and understand, for those who might be interested in those way, what are the main differences between borrowing money from a bank and raising money from a private investor or in equity?
Well, the most relevant and the most important for us, to talk about maybe today would be that when we raise debt, we have to pay interest, right? There's interest from the debt. When we raise equity shareholders, dividends are not obligatory. We may pay them, right? Although if we take this decision to pay dividends, we have to pay all the shareholders equally. If I want to pay myself as a founder, I have to pay my equity investors also, right? So that's the first difference. There's interest, there's dividend. The second thing is interest is not only obligatory, but it's independent of the profit of the company. So whether your company is making profit or is underwater, you have to pay interest. It's obligatory. Bank is not interested in how your company is doing as long as you execute the contract. For equity investors on the other side, if the company is making profit, you, as I said, can pay dividends. But if the company is underwater, there is no profit from which you can pay the dividends. So basically what I'm saying is equity investors are sharing the risks of the company. Bank is not. Bank always wants this interest, right? This is normal. And I would say the most important difference is that we can define bank as a passive investor. It's an investor who puts the money on the table, give me my interest, give me the principal at the end of the given period, but I have no rights to give you any kind of instructions on how to manage your company. When we talk about equity investors, they have all the rights to vote, to choose the management board. They have the right to consult the books of the company. So obviously this situation can change, because in most of the European Union legal system, we can modify these rules, take somebody's vote from them, give them more dividend in return. It can vary, but this is the general rule, right? Equity investors, they have something to say. You are gaining partner in your business. They're a real person that can have influence on you. So these are the main differences, but there's also a few others, the fact that no one thinks about that, but when it goes south, when your project fails and you have to liquidate your company, the bank as a creditor is getting paid first. Shareholders are the last one to get paid. This is also very relevant information for equity investors. For the founders, maybe it can be irrelevant, from their point of view at this moment, because no one thinks they will fail.
So what happens if your company fails and you cannot reimburse the money to the bank or reimburse the money to the investors? What happens in those cases?
Well, that's the thing. Most of the time, banks have some kind of security, collateral, right? They will have this on your real estate, for example. So for the bank, if you stop paying the interest, if you liquidate your company, probably they will not have any troubles, going after your collateral if you gave them one. For equity investors on the other side, well, it's more complicated for them, because if they put the money on the table, they put the money in your company, this is the risk, right? So if the project fails, like bottom line, they risked this money. They can lose. Obviously, the situation in reality is more complicated than that, because we have all kinds of priority clauses, for example, that one investor, like given the fact that he gave you a lot of money, demanded that he is paid first amongst shareholders. So you can modify these rules a certain way. Some investors can also demand some kind of security, like on different company of yours, for example. But this is not this we would have give all situations, analyze given situation. In general rule would be bank is going after collateral, equity investors are risking their money put in the company.
And for the founders or entrepreneurs or anyone borrowing the money, which one of them is riskier? Is there one that has more risk than the other?
Like by definition, I would say, like if you're given, like from the point of view of an investor, if you give some money to third entity, you want to be protected. There's always some kind of risk in it. We are not giving money away on the market, hoping for the best, right? So therefore, for the founders, there's also risk light to raising any kind of money, either from the bank or from the equity investors. But the main risk raising capital from the bank would be not thinking through about the business plan and being late with interest, because that can make bank go after the principal immediately. That can make bank go after your collateral if the company doesn't have money, and that can provoke many type of problems for the company for obvious reasons. Theoretically, borrowing money from the bank is cheaper than raising equity, for the simple reason bank is more protected because of the collateral. They'll probably get their money back. So bank will demand sort of let's say 8% of the return on investment. Equity investor on the other side will demand probably twice as much, 15, sometimes more. So from this perspective, we could say raising money at the bank is better. But as I said, bank is not sharing any type of risk with you. Equity investor, they actually do, right? So also raising more debt is making all the financial situation of the company more dangerous. What I'm saying is, I'll give an example. Let's say an investor is coming to invest in the company, buy 25% of the shares, and it's 2020, company doesn't have any debt, and he comes 3 months later with the same intention, although in the meantime company raised 2 debts at the bank. So from the point of view of an investor, he knows very well that the bank, as I said previously, is getting paid first, just in case things go south. So the risk for an investor is kind of higher. So they will demand bigger, higher return on investment, for obvious reasons. So I would say that both of these forms are risky at some point. Also, raising equity can cause a risk of diluting the capital,
because you are giving a part of your company directly to investors.
Yeah. As we discussed, you're giving them votes, right? You're giving them certain rights at your company, and you have to think about the future giving away these shares.
Yeah.
I'm not saying it's a bad idea, but you always have to think about where it is going, because you have to.
Exactly.
If you don't think about these situations at the given moment when you raise money, it might be too late at the end of the day.
it's true that many, for instance, investment goes with some equity, meaning taking part of the company. And you can see that in some incubator, accelerator, when there is investors willing to give money, of course, to help boost the growth, but also taking part of that. So founders need to think of that ahead. And actually, thinking of that, we'll need to wrap up pretty soon. It's really interesting, but that's the time we have today. Let me ask you maybe a last question. If you will have to go on this way and look for some sort of financing for your company, what is there to be vigilant in the investment contract? Is there some clauses that the founder should pay attention to?
Certainly, there's a lot of things to be vigilant about, and a lot of dangers that are somewhere there in the contracts and the clauses. Like, sometimes, the clause that we might not think is dangerous in general can be dangerous for a given business in the given circumstances. So, like, you have to really pay attention to everything that is there, either in term sheet, engagement letters, or investment contracts, right? Because you're engaging yourself, your company in the future, and you have to pay super attention to it. But if we have limited amount of time, I would focus on certain clauses that not only presents a given risk for investors, for the founders, but also will help us understand better the environment in which we are at the moment of investing in a company. And I think that the best way to describe this kind of environment would be to describe briefly tag along and drag along clause that are very often in investment contracts. Basically, drag along, which is protecting majority investors, is going very often along with tag along, which is there to protect minority. What it means is that majority investors want to make sure that while investing in the company, they can sell the whole, right? They can sell 100%. Even though I have let's say you are an investor, you have 75% of my company, I'm the founder, and I'm with 25% left, right? So you have this drag along clause that I signed in the investment contract that allows you as a majority, to find an investor for 100% of the shares in the company and sell it as a collective, just by notifying me with the drag along clause saying, okay, I found an investor, we have to sell 100%.
So
right?
So you will be forced to sell your shares.
Exactly. So
Okay.
You can find yourself in a situation where even though because when you're served with this notice, drag along notice, you can not oppose to it, right? It is very important. And it is also very important that drag along is protecting majority investors, but not a majority investor. They can unite, right? So we can talk about two investors that have 30% each. They don't have majority, either of them, but together they have 60%.
Exactly.
And they can find an investor. So drag along is basically saying majority is always right. Even though me as a founder, I might be thinking, okay, let's wait one more year, right? In one more year we will sell twice that price. But no, they want to sell right now. And this is very connected to what we were talking about before, that investors are very often looking at the company as a product. It is an investment product.
Guys, keep an eye on that. It seems like it's could be really a strong detail to pay attention when signing the contract.
Yes, we hear very often from founders as they consider their company as their baby, as their achievement, right? From the point of view of an investor, it's a product. Like it or not, if they make return on investment significant in 1 year, they will go for it, and you might lose your company, right? So this is about drag along. But tag along clause, on the other hand, is protecting minority investors, because let's take the example that we already had. As a minority founder who has only 25% of the business, I might hear that you as the recent investor is planning to sell all your shares, right? And I might be getting along just fine with you, but I'm scared because you're planning to sell to some big venture capital. They might not pay me dividends. I don't want to get stuck in this company anymore, right? So basically, tag along clause, which counterbalances drag along, means that me as a minority investor can tell you, hey, tag me along with you, okay? Sell my shares too. And this is also your obligation if we have a tag along in the contract. So basically, why I'm talking about these clauses because they describe very well the circumstances of investment contracts and the attitude of the investors towards your business. Like you might mind also paying attention to all these types of clauses that might lead you to the situation in which you are not even in the right to vote against selling your own company. And this is the situation that the founders of the business that are too enthusiastic towards raising financing, raising equity without any limitation can face at a given moment.
So guys, pay attention to drag along and tag along clauses. Very important. And that concludes our episode today. Thank you a lot, Jerzy, again. Thank you everyone also for being with us. I hope you enjoyed the conversation with Jerzy Krypel, attorney at law at BSJP. Jerzy, any last word on your side?
Well, thank you for having me. I hope we managed to clarify some issues on this two types of financing. Although I would love to have more time to cover options in the investment contracts, but maybe for another time.
It would be with pleasure to discuss further later on, maybe in another episode.
So I wish all the luck to all the investors raising capital, thinking about raising capital, prepare well, and don't forget, to get necessary help from the specialists in order to protect their interests in the future.
If you have any question, get in touch with Jerzy. That's my advice. So thank you again, everyone. The session is available on video on YouTube and audio only on all the global podcast platforms. Follow us on LinkedIn and YouTube to be updated about the next sessions. That's all for today. Thank you et à bientôt. Bye bye.